K-shaped recovery means one thing. The rich are riding the upper arm while everyone else is left clinging to the lower. Packed malls and sold-out restaurants don't mean everyone's thriving. They just mean that the top 20% are spending like crazy. Today, we're pulling back the curtain on America's split economy and why your view may depend entirely on which arm of the K that you're actually on. I was out window shopping for a new espresso machine this weekend with my wife. My longtime followers know that she very graciously wakes up every morning when most of the country is still in deep REM sleep and proofreads my morning missives. Even the best of us make kind of silly mistakes that early in the morning, and believe me, she has saved me from some really embarrassing ones. That said, my wife has become a highly knowledgeable font of financial, capital markets, and economics information. She's become an accidental expert. Those superpowers allow her to see things from the perspective of my 35 years of experience, which of course I share with you every single day. And I just want to take this moment to say, if you like hearing from us every single day, click like and subscribe. Now let's get back to it. I had to make sure that you understood all that before I got on with my story. Now, I happen to be in an upscale mall, and only a few of those still exist, which was literally packed to the gills with folks lining up to spend money. If you read my note and watch my videos, you know that I'm pretty cautious, making sure that you're always well aware of the risks that are lurking in the shadows. I am, at least at the moment, unmistakably bullish on some areas of the market, while being simultaneously nervous about the economy and dubious about the Fed's focus on inflation, the flavor of which it can't even control with interest rates. It's like riding the wave, but cautiously. That said, my wife looked over at me as we passed the many long appointment-only lines of consumers queued up in front of luxury brand stores and said, "This doesn't look like a struggling economy to me." Now, that's not the first time that she said that to me. Now, that's not the first time she brought that up. You can't get a reservation for months at New York's pricier restaurants, even if you're lucky and have friends in the industry. Apartment rents are so high that they can cause one to laugh out loud spontaneously, partially out of disbelief and partially out of sheer panic. How can average people even afford this? Is this even sustainable? Does this story end like a scene in one of those end of days paintings hanging in the Met? Well, before you lambaste me as an elitist, I'm well aware that what I think of as average people is not really an accurate depiction of average people. In fact, if you're reading this or watching this video, you too, though you may not think so, may not be an average people. In the period before and during the pandemic, many economists were opining on what might be a U-shaped or a V-shaped recovery. Remember that? Of course you do, because I cover it a lot. But you might not recall discussions about a K-shaped recovery. It was out there, but it didn't get too much airtime because where most of us sit, it felt very much like a V-shaped recovery, onward and upward to the moon, right? Well, maybe not so much, not for all of us at least. First of all, let's define a K-shaped economic recovery. A K-shaped recovery happens when the economy rebounds unevenly after a downturn. Some parts recover and even thrive while others keep falling behind. Picture the letter K. The upper arm represents industries, companies, or people whose fortunes rise, like tech firms, asset owners, or high-income workers, while the lower arm shows those still struggling, like small businesses, lower-wage workers, or sectors tied to essential consumer spending. Instead of a shared recovery, it's a split one. Growth at the top and stagnation, unfortunately, at the bottom. Well, yesterday I brought up the high price of beef to make a point, and it really is high compared to just a few years ago. Same with chicken and even pork. For this discussion, it's not about why those prices are so high, it's about the fact that they are. And you have to wonder how real average people are making ends meet. Look, I certainly feel inflation effects on my budget, so it must be much more painful for those who earn less. The first clue that the recovery has been K-shaped comes from the Gini index, which measures inequality across the income spectrum. The higher the number, the more uneven the distribution of income. What's important about this indicator is that it tells us whether income gains are being shared broadly or concentrated at the top. Before the pandemic, the US Gini index had already been trending higher, but what stands out is how sharply it spiked post-2020. That spike reveals that while some households saw their incomes recover and even surge, many others did not. The divergence wasn't a blip. It became the defining feature of the so-called recovery. The line shot upward, like the upper arm of the letter K, while the lower arm, the working class, remained flat. You could call it one of the most unequal recoveries in modern history, but the data says it all. The recovery was real only if you were sitting near the top. That widening split is also visible in household balance sheets. The Fed's data on investment ownership shows that the wealth effect, that's an economic term for how rising asset values make people feel and spend richer, has been almost exclusively captured by the top 20% of income earners. The top 1% alone now controls nearly half of all US stock and mutual fund wealth. That is not hyperbole, my friends. It is fact. As the green bands in the chart climb higher, the story practically tells itself. The rich got richer. The lower 60%, by contrast, are barely visible. Those thin layers at the bottom that haven't grown meaningful in 15 years. For anyone who wonders why Wall Street feels buoyant while Main Street feels brittle, well, there's your answer in one single chart. Asset inflation lifted portfolios, not paychecks. You can also see the same split in the labor market. The unemployment rate by educational attainment is one of the clearest examples of how opportunity now tracks education, and by extension, income, more tightly than ever. Those with a bachelor's degree or higher have an unemployment hovering around the low 2s to 3s, while those without a high school diploma are stuck near the mid to high 6s. That's not just a gap. That's a chasm. The implication is that the labor market recoveries are no longer rising tides. Instead, they lift one set of boats and swamp another. Every major downturn in recent decades has reinforced this divide, but this time it feels starker because the top half of the workforce also gained flexibility, remote work, and digital leverage, luxuries unavailable to those who punch clocks or rely on hourly wages. Education has become the ultimate risk hedge. Home ownership tells another side of the story, and is a painful one. Among the lowest income households, the bottom 20%, the share of homeowners has fallen in recent years. After peaking around the pandemic, it has been sliding steadily lower. That may not sound catastrophic, but in a country where home equity represents the largest source of household wealth, losing access to ownership means losing access to long-term wealth creation. Rising mortgage rates and home prices have simply priced many out of the market. For millions, the American dream now looks more like, well, just a dream. Contrast that with households in the upper middle slice. Think the 61st to 70th income percentile, where home ownership has actually increased, particularly over the past few years. As lower income buyers were squeezed out, higher income buyers, often with stock market windfalls and easier access to credit, well, they stepped in. It's another K-shape, but within a larger K. One line falls and the other rises, and between them sits the middle class, increasingly hollowed out. Home ownership used to be the great equalizer, but now it's unfortunately the great differentiator. Put it all together, and the income inequality, the wealth concentration, the education-driven labor gap, and the split in home ownership, and you have the anatomy of a K-shaped economic recovery. From the street level, it's easy to miss because the upper arm of the K is very visible. You see it in crowded restaurants, booked solid, luxury retailers, and vacation photos flooding social media. Those are real signals of confidence and spending, but they're also coming from a smaller and wealthier segment of the population. The lower arm is quieter, less visible. It's families scaling back grocery lists, skipping car maintenance, or relying on credit cards to bridge monthly gaps. It's the retail worker whose rent rose 15% while wages barely moved, or the young professional locked out of home ownership despite doing everything right. This divergence matters because it distorts how we interpret the economy. When the S&P 500 rallies and unemployment sits below 4%, it's tempting to call that a healthy recovery. But if the gains are concentrated and the vulnerabilities are widespread, that recovery is brittle at best. Policymakers, investors, and ordinary citizens feel it differently, depending on which arm of the K they're on. For the upper tier, the higher asset prices create a buffer. For everyone else, higher prices for essentials like food, housing, and healthcare, well, they erode real income and savings faster than any wage gains can offset. What's particularly interesting is how the dynamic feeds back into the markets. The very inequality that defines the K-shaped recovery reinforces bullish momentum in financial assets. Those who already own stocks, property, or businesses see their wealth expand, which in turn supports more investment and spending at the top. That's the wealth effect again. But because consumption patterns differ by income, the macro data can appear strong even when large parts of the population are still struggling. It's a paradox that confuses policymakers and investors alike, and one that leaves the Fed chasing headline numbers that mask underlying fragility. If you zoom out, the K-shape is not new. It's the culmination of decades of structural forces. Automation replacing routine labor, globalization rewarding capital, overwages, and education becoming the key to mobility. The pandemic simply accelerated it. Stimulus checks and asset inflation temporarily lifted both arms, but once the short-term aid faded, gravity pulled the lower arm back down to ground. The post-COVID economy became a mirror of its inequalities. AI investments surged, high-end consumer demand exploded, and low-wage sectors unfortunately stagnated. Now, as we debate rate cuts in the next phase of fiscal stimulus, the question isn't whether the economy is growing, it is, but who is it growing for? That's the question. Investors see record highs, but many households see record strain. That's why it's dangerous to make investment decisions based purely on personal experience. If you're fortunate enough to be in the rising arm of the K, your world looks strong, resilient, and profitable. But that's not the full picture. The real economy, where spending, employment, and opportunity interact, is far more uneven. And when the gap between perception and reality grows too wide, markets eventually take notice. So before you assume that a packed mall or a bustling restaurant means the economy is firing on all cylinders, take a step back. Look at the data. The handwriting is on the wall, or more accurately, on the charts. The K-shaped recovery is not a theory, it's an observable fact. The top is rising, the bottom is stalling, and the middle is unfortunately shrinking. I still haven't bought that espresso machine yet because I'm still recovering from the sticker shock. Maybe that's my own personal contribution to the lower arm of the K, but it's a reminder that our individual experiences don't define the economy. No, they're just data points within it. Step back. Think broadly, and you'll see what's really happening. Two very different recoveries unfolding at the same time. So your truth bomb for today is this. The economy isn't just heating up or cooling down, it's splitting. And if you invest based on your own lens, well, you're missing half the picture. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out. And I'd love to get comments from you, so drop them below. We read those comments, and we're going to be picking the top 3 and putting out videos on those comments. Put those comments in there. We love them.